Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to talk about investing in stock market. Why invest in common stocks? First, let's talk about the concept of residual owners. As we know, common stockholders of a firm are the owners, the true owners. Stockholders are entitled to dividend income and a prorated share of the firm's earnings, which means stockholders get to share the profit of the company. But stockholders will only receive the dividend after all the firm's other obligations have been met. Therefore, the company will first pay the bondholders and preferred stockholders. Then only it will pay the common stockholders. So in case the company doesn't perform well, or something goes wrong with the company, as a common stockholder, you are always the one to suffer. Probably, if the company goes bankrupt, you may not even get a single cent back. However, if the company makes a good profit, as a common stockholder, you are likely to receive a good dividend payment as your reward. The following are some reasons to buy common stocks. First, stocks allow investors to tailor investments to meet individual needs and preferences. Probably, your investment goal is to save for retirement fund. Common stock is a suitable tool to meet your individual need. Second, stocks may provide a steady stream of current income through dividend. If your aim is to enhance your current income, dividend is a good source of income. Usually, companies will pay dividend to the investors on a quarterly basis. So every 3 months, you will receive some money from the company you invest. Third, stocks may increase in value over time through capital gains. Some people may not need dividend, as they may feel that receiving dividend is too slow to accumulate their wealth. So, they prefer capital gain. These people may focus on high-growth stocks, that is, those stocks with potential to increase a lot in their stock prices, then that would be their choice. In short, stock market is a place for people with different needs and preferences. No matter you prefer current income or capital gain, you will be able to find a suitable common stock to meet your needs and preferences. Next, let's talk about the advantages of stock ownership. It provides opportunity for higher returns than other investments. If we compare stocks to fixed deposit savings, for sure, stocks have a higher return. Fixed deposit only pays 2 to 3% annual interest. However, over the past 50 years, stocks on average achieve 10% annual return. It is much higher than high-grade corporate bonds that averaged 6%. Stocks are good inflation hedge, since the returns typically exceed the rate of inflation. Say, if the inflation rate is 4% whilst the stock return is 10%, then it is more than enough to cover the inflation. And it is so much better than putting your money in the bank savings account. It is easy to buy and sell stocks. Of course, when you invest, liquidity is very important. Especially when you need cash for emergency use, it is easy to sell the stocks and exchange for cash. Price and market information is easy to find in the financial media. To make a wise investment, we need a lot of information for making decision. It will be easy to get the latest information regarding the common stocks from online sources. Daily market performance can also be obtained online easily. Unit cost per share of stock is low enough to encourage ownership. The good thing about purchasing common stocks is the minimum purchase is 1 lot, in which 1 lot equals to 100 shares. So, if you only have few $100, probably you can start investing in the stock market now. Next, let's look at the disadvantages of stock ownership. Stocks are subject to many different types of risk, such as business risk, financial risk, purchasing power risk, market risk, and event risk. These risks may cause the company to have a lower profit, or even lead to bankruptcy. It is hard to predict which stocks will go up in value due to wide swings in profits and general stock market performance. Even you know how to analyze the market information, it is hard to predict the share price movement. Low current income compared to other investment alternatives. If we compare the dividend rate to the bond interest rate, dividend rate is usually lower. Many companies don't even pay any dividend. So, if you prefer receiving more current income, you should consider buying bonds. What is dividend? Dividends represent the return of part of the profit from the company to the owners, that is, the stockholders. When you buy common stocks, you are the true owner of the company. So you are entitled to share the profits of the company through receiving dividend. When you buy common stocks, you may receive two types of returns: capital gain and current income. Here, dividend income is basically the current income. If we compare capital gain and dividend income, in fact, dividend income is more predictable than capital gains. That's why investors who are seeking lower risk always prefer dividend income. In the US, dividends are taxed at maximum 15% tax rate, same as capital gains. However, in Malaysia, capital gain is not taxable. Investors are not required to pay tax for earning capital gain. But for those who trade shares as an occupation, which means they buy and sell shares to earn for their own living, capital gain is taxable under income tax. Whilst for dividend, it is only taxed at corporate level, that is known as withholding tax in the company's account. More specifically, withholding tax is the dividend tax paid by company on behalf of the investors. Therefore, investors do not have to pay extra tax for dividend in Malaysia. According to the research, dividends tend to increase over time as companies' earnings grow. On average, the annual increase is around 3 to 5%. So investors may expect an increase in the dividend as well. Stock dividend, it is a special type of dividend payment. Company pays dividend to you in the form of additional shares of common stock. That means the company doesn't pay you cash, but they pay you extra stocks as your dividend. For buying common stocks, the following are the common investment strategies. First, storehouse of value. For pursuing this strategy, safety of investment is the primary goal. The main purpose is to preserve the value of the common stocks. So investors may use high-quality blue-chip and non-speculative stocks under this strategy. Most likely, the stock prices may not have a big change. Second, to accumulate capital. For this strategy, growth of investment is the primary goal. Investors may use growth-oriented stocks to generate capital gains. For growth-oriented stocks, the risk is higher, so the stock prices may go up and down a lot. Third, as a source of income. Under this strategy, current income is the primary goal. Investors may use stocks with dependable flow of dividends. In other words, those companies that pay good dividends will be preferred under this strategy. Next, what is a bear market? Have you come across the terms bull market or bear market? When the market drops, it is not necessarily a bear market. Routine decline happens when there is a drop of 5% or more in one of the major market indexes like the Dow Jones Industrial Average (DJIA) or Kuala Lumpur Composite Index (KLSE). Market correction happens when there is a drop of 10% or more in one of the major market indexes. Bear market happens only when there is a drop of 20% or more in one of the major market indexes. The same logic applies to a bull market. Alright, for the following part, we will talk about Malaysian Stock Exchange. Kuala Lumpur Stock Exchange, KLSE, is the stock exchange in Malaysia. KLSE is a place where stocks are traded. Stock exchanges allow investors to buy and sell shares of a company among each other in a regulated physical or electronic space. Bursa Malaysia is an exchange holding company established in 1973 and listed in 2005. It operates a fully integrated exchange, offering the complete range of exchange-related services, including trading, clearing, settlement, and depository services. Bursa Malaysia offers a choice of two dynamic markets to companies seeking listing in Malaysia. First, main market. It provides an ideal platform for established companies to raise funds. Second, ACE market. It is an alternative sponsor-driven market designed for companies with growth potential from all business sectors. In order to be listed on the main market, the companies will have to fulfill the requirements of profit test, market capitalization test, and infrastructure project corporation test. For being listed on the ACE market, there is no minimum operating track record or profit requirement. Under the listing requirements of the main market, the company must ensure that at least 25% of its total shares issued are spread for public shareholders, with a minimum of 1,000 public shareholders holding not less than 100 shares each. For the listing requirements of the ACE market, the company must also ensure that at least 25% of the company's total shares issued are spread for public shareholders. But it only requires a minimum of 200 public shareholders holding not less than 100 shares each. For the Bumiputera equity requirement, companies listed on the main market are required to allocate at least 50% of the public spread to Bumiputera investors on best effort basis. However, for companies listed on the ACE market, there is no such requirement upon initial listing. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.